Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to go over stocks with X dividends next week. So every Wednesday we put out a video covering stocks that have X dividends next week. So as long as you buy that stock the day prior to the X dividend, you will then get paid out over the next few weeks or in the next month. So in this video we're going to cover roughly 60 to 75 stocks, screen them for price to earnings ratio less than the S&P 500 average, which is right around 25, dividend yields over 1.5%, rising revenue, rising net income, and rising free cash flow. And then based off what the number of stocks that we have remaining, we can take a look at which of them are currently trading with a yield over price over yield. We can take a look at their 200-day moving average and see how they're currently priced. And then we flip over to Dividend.com, see how long they've continued to increase their dividend, how long that dividend growth has been there, their payout ratio. Generally, we end up with a good, 3 to 6 stocks that could be potential follow-ups to take a look at their quarterly earnings, take a look at their year-over-year returns, and so on. So that's what's in store today. Of course, if you are brand new to my channel, I do make stock market, real estate related videos, so go ahead and hit the subscribe if you have not. We are currently doing a gift card giveaway. There's a video in the description below and also in the comment section. Click on there, go to the video, leave a comment with your favorite investment vehicle, and once we hit 1,000 subscribers, we're going to be doing that giveaway live. So let's go ahead and get into it. Okay, so on the screen before me, I have the DARS, the Dividend Advantage Rating System. This measures a dividend stock based on its relative strength, its overall yield attractiveness, its dividend reliability, dividend uptrend, and earnings growth. So basically the strength of the company, how close is the trading near its 52-week high, yield attractiveness, it doesn't want anything between a 10, it doesn't want anything higher than a 10% or less than a 1%. Those could either be extremely risky or they wouldn't be very beneficial to long-term investors. Healthy dividends are anywhere between 2 to 6%. Dividend reliability, if that company were to fall in earnings by 50% and say its payout ratio was 90%, that would mean that its earnings or its payout ratio would then double to 180%. So we want those healthy payout ratios of 50% or less. So the better the payout ratio, the better the dividend reliability. Dividend uptrend, how likely are they to pay out and continue increasing their dividend year over year? There's companies out there that have paid out dividends for hundreds, over 100 years. Coca-Cola, Johnson & Johnson, Procter & Gamble, those have all paid out dividends for more than 25 years. We have earnings growth over the next 4 quarters. Is the stock expected to continue growing in earnings and over the next 4 quarters? So it measures all of that information and it gives a stock a specific number. Highly recommended is 4.6 to 5. Recommended is 3.6 to 4.5. So I like to look and screen for anything above a 3.6. Some weeks there's so many stocks that I never even reach 3.6. I'll screen the first 60 or 75 stocks. Other weeks, such as this week, we will only have 35 stocks that have a rating of 3.6 or higher. So that's exactly what we had. I went over to Dividend.com, clicked on X dividend dates, punched in my week between Sunday and Saturday, hit common shares, searched, sorted it by the DARS rating system, and we have 35 stocks here. So what I did is I copied everything above a 3.6, which is Heartland Express, moved it into my spreadsheet here, and you can see, and now I began copying each ticker symbol into Y charts. Boom, boom, boom. Did that over and over. Now, I'm trying to speed these up. I'm not trying to make a 20, 30-minute video. By that time, that's a long process to be sitting through, going through each PE ratio, dividend yield, its revenue, free cash flow, etc. So what I've done is I've already pre-screened everything. I'm just going to go over why these 6 stocks out of the 35 remain here. Now, first, we have the ticker symbol, the company name, the DARS rating system that they're given, 5 being the highest, 3.6 being that recommended. We have the ex-dividend date, meaning that you have to buy the stock on the ex-dividend date or prior to be eligible for that dividend payout on the following either week or month, etc. Most of these have, within 2 to 3 weeks is normally what they pay out. Here, you buy it on the 19th, have the ex-dividend on the 20th, get paid out on the 29th. you get paid out 14 cents per share. It's a qualified dividend, meaning that when you do your taxes at the end of the year, if you're trading in a taxable account, that, because it's qualified, will get taxed at either a 0%, a 12%, or a 15%. It'll actually get taxed as a dividend, like as a qualified dividend. It depends on your tax bracket how you'll get taxed. Whereas if it's an unknown or if it's not a qualified dividend, you'll actually get taxed at your regular income tax bracket. If you're in the 2018 tax brackets, I believe it's 22. If you were in the 25, and so on. If you were in the 15, you're now in the 12. So if you are it's an unqualified dividend, then you would pay out in your regular income tax bracket. Now, if you trade these within a Roth IRA, you can either defer paying taxes until 59.5, such as in an IRA, wow, or you won't have to pay taxes at all if you buy within a Roth IRA. And then here we have the price, current stock price, and the dividend yield. Okay, so I've already gone through and done this, and I'm going to go ahead and expand my Y charts. And these are the 6 stocks that I have remaining. Now, why did I pick these? I'm going to go ahead and show you. Now, the current S&P 500 average is, of course, 24.7, right around there. So all of these have a PE ratio of 25 and below. So, you know, the highest here being 20, the lowest being 10.32. Next, after I did that, I went to dividend yield. I knocked anything with a 1.5% dividend yield or less, and anything with a 10% or higher. Really, there wasn't anything in this list that's rated at a 3.6 or higher that generally has a 10% yield or higher. Now, I did knock out a number there of dividend yields that had under 1.5. And what we have remaining here are 6 strong-looking stocks. Now, of course, I didn't stop there. I continued on to over the last 10 years. Let's go ahead and change this to percent change. I want to check out their revenue, net income, and free cash flow. I want to know that this company is financially strong and has growing year-over-year revenue, net income, free cash flow. So here, for example, Broadcom, its free cash flow has reached the it's 5.11,000% higher than it was 10 years ago. Its revenue is up 1.15,000% over the last 10 years. And it's, this average is very high. Net income up 30% year over year. And it average, over the last 10 years, it's up 307%. So Broadcom, for example, very strong, financially strong company. Here we have Car Auction Services, again, up in net income, up in free cash flow, up in revenue. Douglas Dynamics, right along there, triple digits across everything. The revenue increasing 18% year over year, free cash flow up 29% year over year, and net income up 46% year over year. Very healthy looking stock, moving on upwards. And again, I like to use General Electric as the example of a declining one. This, you can see that it completely changed around in 2015. It had been trending down, downwards prior, but it was very slow. All of a sudden in 2015, boom, dropped in net income, boom, dropped in free cash flow, and their revenue just continued to kind of blah out to the side. So that's why I like to look at these healthy looking stocks. Cincinnati, again, rising net income, rising free cash flow, rising revenue. Portland General Electric, very high free cash flow of 900%. This can change. You can see these big spikes here. If you look over the last the yearly 10Ks, you're probably going to see some acquisitions that were taking place, some change within the company. Maybe they acquired some smaller companies within the area and such. So that's always something to look forward to. It's a utility company, so revenue may not be the highest, but maybe they're kind of charging their customers more so that net income goes up year over year. Very healthy return. Year over year, 11% on net income and 0.9% on the revenue year over year. Las Vegas Sands, we have giant amount of free cash flow, net income in the triple digits, and revenue in the triple digits as well. 14% year over year gain in revenue, 36% year over year gain and net income. Very healthy looking stock. So that's what I've screened the stocks for so far. Now, if we want to do a little bit further, if we want to look at what stocks are currently trading at what would be considered maybe like a value buy. Maybe they haven't shot up recently as much and kind of returned back to their norm. Broadcom, for example, They dipped back in February, March timeframe, peaked out again, and what looks like, let's see, March, looks like it peaked out before diving back down, and it just came back up. So this one could be a very risky buy right now. It looks like it's kind of, it's peaked out back here in the past in early January, peaked out again in March. It currently could be peaking out and currently could trend back down. So Broadcom, for example, where it does have it does have good financial metrics, the current situation of its price, it could just be like a risky buy. This one could go from 261 back down into the $225 range, $220 range. So that one, for example, that would be a really risky opportunity right now. Cars auction services, very healthy, steady increase in price. You know, it did decline in that February, March timeframe, but then it did recover. It's been kind of trending either sideways or a little bit lower, but there's definitely potential there. It's not too unhealthy. You can see, on the other hand, its dividend yield, it did have a high dividend yield of 3.0 back in July, August of 2017. But of course, the stock has been steadily rising up over the last year. If we change it to percentage, we can see that over the last year, it's up 26.29%. Its dividend yield, you've lost 13% of the dividend yield. That's not 13% of the total dividend yield. That's just the payout. You would have been paid out 13% more had you invested a year ago. Yeah, just about a year ago. So that's cars, for example. So what we want to look for are stocks. So this, for example, it's maxed out as well. This is actually at record highs. It's hitting new highs right now. And it's a dividend stock that's on X dividends next week. Here could be one that could be a potential buy. It's actually down for the year. Over the last year, if we change it back to normalized percent change, it's currently down since a year ago. It's down 2.35%. Now we know that it has a great dividend or PE ratio, good dividend yield, good financials, but right now maybe its public view isn't out there, you know, in the public appearance may not be in favor of the stock. That's what's driving it down. It's also a financial institution, so I'm not sure why, you know, maybe rising rates or being stalled with the rates. This could be just one to kind of look at why has it been getting so much hate lately, and then kind of go on from there. But it could be a good buy right there, buying opportunity. Down for the year right now, roughly 2%, and you're getting a really high dividend yield of 2.9. This is one of the highest dividend yields in, say, let's see, back in 2016, looks like maybe March timeframe, March-April timeframe. That was the highest point. That was the last time you can get a dividend yield of around 2.9%. Continuing on, Portland, its price did come down very high. If we bring in, this is the new one I added here, the 200-day moving average. You can see that the 200-day moving average for Portland General Electric is at a 43.75. It's actually below its 200-day moving average. So this could be a good buying opportunity. But again, price is over. It's under the 200-day moving average, but it's currently above. You know, it's spiked up pretty recently as of. I wouldn't consider that a spike up, actually. Let's go ahead and put that in there. Back to the year. I like to look at the year change for the year because I like to stay current. I don't like to use past history. I like to just see its history as far as its financials go. Does it have rising revenue, net income, free cash flow? That gives a good perception of the company as heading, you know, the leadership. That gives me a good perception of the leadership. Has the leadership in that company done well over the history of the company to have propelled it forward, you know, positively? And of course, how long has that CEO been in place? What are his plans going forward? You know, those are things I like to look at after I've done my general financial metric screening process. Now here, we looked at it again. 200-day moving average is currently below the 200-day moving average. If you go back through, I guess I could show you guys the 200-day moving average on these other ones here in the red. So not quite below the 200-day moving average for the year, but still, as we've seen it here, as far as it's spiked up right now. It's actually above where it had been in the past. The last time it fell pretty hard. So cars, not quite below its 200-day moving average. Douglas Dynamic, not quite below its 200-day moving average. CINF, way below its 200-day moving average. Again, but this one could just be, look at financials. Financials were there. Take a look at this balance sheet. I know that we're going to do another process here. We're going to show you how long it's been paying out those dividends. It's actually pretty nice up there. Here, Portland General Electric underneath its 200-day moving average. And then Las Vegas Sands Currently above his 200-day moving average, price above yield right now. I'm going to go ahead and take that out. So there we are. Those are the 6 stocks. Why they remained on my list. They all have PEs under 25, dividend yields over 1.5. Their revenue, net income, free cash flow, all positive. Now the next step I like to do is go over to dividend.com. So ticker symbol CINF. This one actually came in first place with 57 years of continued dividend growth. It does have a little bit of a high payout ratio. I don't like to invest in stocks generally that have a payout ratio above 50 to 60%. 50% being pretty healthy, because if that stock were to lose half of its earnings, it goes through a really tough time, then 50%, or if it lost 50% of its earnings, a 50% payout ratio would only double to 90%, but that would be very unlikely. So that's just a scenario I like to use. Still 60% usually where I cap out at. They does have a dividend yield of 3.03, pays out $2.12 per share, currently priced at $70.06. This would be one I would look into as to what caused it to go down recently. So they're on June 19th. That is next Tuesday. You would have to buy it on Monday or prior to be paid out on the 16th of July. Now you can see here that over the last, boy, when did it pay out dividends? It's paid out dividends and continued to pay out dividends since 1961. It even did a stock split there where it gave you 3 for every one that you had. So it basically tripled your dividend payout. If you had $100 in dividend payout every year, they give you 3 shares for every one, basically tripling your dividend payout. They also have some special payouts here every once in a while. If we go back over here, they paid out a special dividend payout of 46 cents per share, and then another one here of 50 cents per share. So it could be a great long-term buy and hold stock. You know, of all the financial institutions that cut or paused their dividend during, 2008, this one did not. They deal with property and casualty insurance, so pretty healthy, been around quite a while. So again, look into the moat. How hard is it to get into that specific field? Do they have any products or services that they offer that are not competing? Are they losing market cap, gaining market cap on their competitors? Who are their competitors? And so on. So in second place, we have Portland Electric, ticker symbol POR. This is the electric utilities. 12 years of dividend growth, payout ratio at 66.5. Utilities themselves, they kind of have that monopoly. No one's going to come in and take them. It's federally regulated, so it's pretty safe to. There's always risk with any stock. You can see that it's only paid out dividends since it's only had continued dividend growth since 2006. Dividend yield right now of 3.6, payout ratio of 66.5. Ex-dividend is June 22nd, which is next Friday. So you got to buy this stock on Thursday or prior, then you would get paid out on the 16th of July. We go down here, we go back. Okay, so here they cut their dividend from the last time they paid out dividend was back in 1998, and then they continued, they turned on their dividends back on in 2006. So a company doesn't have to pay out dividends. They can cut their dividend at any time, but that's what it's great to look for stocks such as CINF, Cincinnati Financial, that does have that, that reliability there. I like to look for stocks that have paid out dividend growth over the last 10 years. Didn't have a reason to cut it. Looks like maybe they were going into some tough times during that 2K thing, the 2000 recession point, and they just kind of cut it instead. In third place, we have Broadcom Limited. 8 years of dividend growth, payout ratio, very healthy, 41.4. Dividend yield, 2.68. They pay out $7 per share each year, but they're priced pretty high at $261.43. Their ex-dividend is on June 19th. That's on a Tuesday, so you got to buy it on Monday or prior, and then you'll get paid out on the 29th of June. Had some steady increases there, and then they kind of didn't pay out their quarter. So let's see, they've been since 2010. Okay, so the whole time that they've paid out dividends, they have continued to raise their dividend quarter or year over year over year. So this, for example, there's no indication that they ever cut it. They just continue to raise it over the last 8 years, which is how long they've been paying out that dividend. In fourth place, we have ticker symbol KAR, Car Auction Services, 5 years of dividend growth, 46.8, dividend yield 2.54. Their ex-dividend date is on June 20th, so that's Monday. So you got to buy this stock this Friday. Oh, the 20th is actually next Wednesday. So you got to buy it on Tuesday or prior. You would then get paid out on the 5th of July. Taking a look here towards the bottom, 5 years since 2013. So if we go back and look at 2013, what do they do here during this time frame? You can see that they cut their dividend between 2006 and 2012. So that recession period hit, they just decided just to cut it out completely and didn't pay out any dividends there. So that's very similar to what Portland Electric did. Was that Cars? Yeah, that was Cars. Okay, same place, you know, same area. We have Douglas Dynamics. This is at 5 years. I rated this a little bit higher just because their payout ratio is higher. So ticker symbol PLOW, dividend yield of 2.22%, payout ratio 50.7, 5 years dividend growth since 2013. They're in consumer goods. They sell out auto parts. Their ex-dividend date is on the 18th, which is next Monday. So you got to buy this one on Friday or prior. You would then get paid out at the end of the month on the 29th. So this one, 2013, what took place? Let's see, they did a special payout here in 2011. Oh, they just locked the dividend. So what they did here, they did a one-time special payout here in 2011 and just locked in that dividend. So really, they've actually increased their dividend since, let's see here, 11, 21. So it looks like during this period here, they locked it for quite a while at 20 cents. And then in 2012, they began to increase it. So they had it locked from 2010 to 2012, and then since then have continuously increased it. But you can see that the increases here are just a penny. So that's where it talks about that dividend growth. You want that healthy, you know, 10%, 7-10% dividend growth per year. Las Vegas Sands, ticker symbol LVS, 5 years dividend growth, pretty high payout ratio of 82.9, dividend yield of 3.74, annualized payout $3 per share. They do resorts and casinos similar to Wynn Resorts. This one's ex-dividend is June 19th, which is next Tuesday. You got to buy it on Monday or prior. You would then get paid out at the end of the month on the 28th. 2013, what took place back in 2013? Let's take a look here. Looks like they did a special one-time payout, and they pay out quarterly. So let's see here. It looks like they maybe, let's see, they were paying out 25. They increased it to 35. Looks like they've actually done well. They only started paying out dividends back in 2012, but looks like they've actually increased their dividend every year since then. So maybe what happened here, it just included, yeah, 2013 is where they had their first year of increase in dividends. So really they've been paying out dividends and continue to increase their dividend year over year. They've only just paid dividends since 2012. So no negative news there. So that is that's the 6 stocks that we screened today. Again, first place would probably be Cincinnati Financial, just because taking a look at their price and their dividend yield, it looks like a great buying opportunity. You're also buying it at a good PE ratio with a forward PE ratio of expected to drop. You can see their current PE ratio is at a 22.73. Their forward PE is at a 14.33. Take a look at their price to sales ratio, very healthy at a 2.1. Let's take a look at their book value. It's an financial company with a price to book value less than 1.5. It's trading below its 200-day moving average. There's 200-day moving average there, 74.12. This one is most likely to rebound just because its financials do, it's showing that it has a very strong balance sheet in a sense. So this was something I had posted earlier yesterday on Tuesday. I made a video covering all the stocks within the Dow that are currently down year to date. 7 of them were showing strong financial metrics. So I shared this across Dividend investors. I had a couple investors that had mentioned that investing in stocks that aren't performing well is counterintuitive. And of course, my response is not to say that they aren't doing well. The public appearance of the company may be in the decline, but financially speaking, they are all value plays. They all have rising revenue, rising net income, rising free cash flow. So in all sense, it does make sense to take a look at them a little bit further. They could be down year to date and over the year, but they could still be at a great buying opportunity. So that is it for this week. Hopefully you have enjoyed the video. Try to make it a little bit not so timely. And that is it. So hopefully you guys have enjoyed it. Remember to like, comment, subscribe, share with your friends if they're a dividend investor. And of course, as a friendly disclaimer, I'm not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor myself, trying to help others make their money work for them, looking for some great buying opportunities, some value plays. So that is it for this video. Thank you guys for watching. I will see you next time. Have a great day. Bye.